Hello everyone and welcome back to Academic Scope. Today we're covering topic 2.8, the role of money and financial markets. This is the last topic in GCSE OCR microeconomics, so well done for making it here. Let's view the specification and what it says we need to know. We need to be able to explain the role of money as a medium of exchange, explain the role of the financial sector for the economy, including financial institutions such as banks, building societies, and insurance companies. Evaluate the importance of the financial sector for consumers, producers, and the government. Analyze how different interest rates affect the level of saving, borrowing, and investment. And calculate the effect on saving and borrowings in the change of the interest rate. Now, notice how it says evaluate and analyze. These are the two 6-mark questions that we could be asked to answer based on this topic in the exam. So, these are some of the first definitions and explanations you need to be able to know. Money. Anything that is generally accepted as a means of payment for goods and services. And a key point you need to know, checks, debit cards or credit cards are not actually money. They enable the transfer of money. Money used to be gold back in the day, but now it's considered cash, as we give value to cash. Debit cards take money from your account and then transfer it to the seller. Credit cards, however, enable you to buy goods and services, whether you have money in your account or not, and then you pay a 30-day loan with interest if not paid in time. Retailers have to pay a charge when taking credit cards, so some might refuse. A double coincidence of wants is in bartering. It's when you find someone who has something you want and is willing to exchange for your goods and services. And this was done before money was introduced, when you were to trade, for example, a chicken for a sheep. And a medium of exchange is anything that sets a standard of value of goods and services acceptable to all parties in a transaction. Some more definitions you need to know. The financial sector. It consists of financial organizations and their products, and the flow of capital. It helps markets function and the three main economic groups to carry out economic activities by borrowing and lending money. Investment. It is the purchase of capital goods that are used to purchase future goods and services, also an asset purchased to provide an income in the future and/or to be sold at a profit. When you buy capital goods now and they are used to produce more goods and services in the future, that is an investment. For example, a firm invests into higher quality machinery that's able to produce more goods and services than before. The interest rate is the cost of borrowing and reward for saving. When you borrow money, let's say for example £1,000, and the interest rate is 5%, that means you have to pay £50 back on extra in addition to the £1,000 you already borrowed. But let's say you save £100 and the interest rate is 5%. You would then take an extra £5 in addition to the £100 you saved with the bank. Building societies. These are mutual financial institutions that are owned by its members. Its primary objectives are to receive deposits and lend for the purchase of property, otherwise known as mortgages. And lastly, insurance companies. These are financial institutions that guarantees compensation for a specific damage or loss in return for an agreed upon premium. For example, death insurance. If a family member dies, it's often common that that person has death insurance and their family receives an agreed amount. It could be in the millions or in the hundreds of thousands, or it could be the paying of the house's mortgage. The specification states you must be able to define the role of the central bank versus the role of commercial banks, and on the screen are the main differences. The central bank issues banknotes. They control monetary policy by setting the bank rate, which is the interest rate set by the Bank of England, from which all other interest rates are calculated. They provide financial stability to the economy by ensuring UK citizens trust financial organisations. They manage the country's foreign reserves, and they act as a bank for commercial banks and the government, giving them loans. On the other hand, a commercial bank takes deposits from consumers like you and me, and turns them into assets for the bank by either investing or lending that money to other consumers. Banks such as HSBC will charge interest rates higher than the bank rate to borrowers, but they will provide interest rates lower than the bank rate to savers. They accept deposits and pay interest on them, and they can make payments on behalf of customers, for example, through debit cards or checks. And they issue loans and even offer safety deposit boxes to store jewelry or important documents. A sixth marker the specification states you could be asked to answer is evaluating the role of financial sector for consumers, producers, and the government. And in order to do this, you have to understand these three things. Credit provision. It allows people to buy now and pay later, increasing consumption, and banks and people can use credit cards to pay before receiving income, or firms can take loans to expand without having to save. Liquidity provision. It refers to how easy it is to turn assets into cash. Banks are the main providers of liquidity to households and businesses, and this allows them to continue functioning. And risk management. It allows firms and individuals to pool their risk from exposure to financial markets. Evaluating the importance of the financial sector for consumers, producers, and the government. Let's first talk about credit provision. It allows people to buy now and pay later if they don't have enough funds. And consumers only have to pay a small percentage of the house cost up front and can pay it over a long period of time. This is known as a mortgage. For producers, they're able to borrow money to allow for growth or expansion without saving first. And producers can also provide credit and collect interest, so the other way round. The government can use credit to spend money when they have not collected tax revenue yet, and it allows a budget deficit to exist. There are many more uses, and we'll go over these in a second when we go through the practice 6 marker. Liquidity provision. Consumers can access liquidity from banks if they don't have enough funds. When consumers know they can access funds really easily, they are more willing to use this, and it increases consumption and aggregate demand. For producers, they can access cash from banks if they do not have enough revenue at the time. Banks or producers can even provide overdraft and liquidity facilities. And for the government, it helps to finance public spending. In recessions, such as the 2008 financial crisis, the government injected cash into markets to prevent economic crisis and stimulate demand. And lastly, risk management. For consumers, it provides financial security. Insurance companies, for example, prevent catastrophic losses from accidents or disasters, such as home insurance. Their money is managed safely, and it increases confidence. For producers, it helps with business continuity, helping avoid costly shutdowns. For example, it stops random parts of the production process from stopping, as they're able to pool their risk elsewhere. And it helps maintain profit. For government, it's similar, but it helps to maintain economic stability, for example, through maintaining pension funds. Now, because this is an evaluate question, you have to be able to evaluate. The financial sector may not be important because of the following reasons. The rate of interest affects usefulness. If the rate of interest is really high, borrowing might be less reasonable. Loans may have been important initially to a business, but less important now. They might be funded by subsidies or private investment. If businesses deal in cash, credit provision is less important, especially if they have younger customers who only rely on cash. Credit cards cause the business to be charged, so they may not want to accept them. And consumers who wish to pay off the credit cards each month might not want to risk high expenditure. And the rate of interest is a cost to finance. The best part about these evaluations is all of them come from the OCR GCSE economics mark schemes, so feel free to use them. Now, a practice 6 marker. I want you to read through the case study using the skills I showed you in one of the first videos. I'll link down in the description if you want to see it. Evaluate the importance of the financial sector for small producers, such as Tom. Use the information given in Extract 3 and your own knowledge. Pause the video now and attempt to write down a full answer. Great. Now, we're going to go through what the mark scheme says you should have written. I want to note that there are many other answers that aren't in the mark scheme that are equally valid and would get you 6 out of 6. Some importance of the financial sector is the provision of loans so he can buy equipment, or provision of credit to his customers so they can purchase his product. They offer overdraft facilities to Tom over periods when costs exceed revenue, so he can continue surviving and paying maybe employees or paying fixed costs. They provide insurance for his property and equipment, and can safekeep his revenue and money, and can help his savings increase by providing interest. In some evaluations, is the rate of interest on savings is important, as if it's very low, it's not helpful. Insurance for his car allows him to drive and work, so it is very important. And life insurance provides safety, so it's also of importance. This may only have been important initially, like his loans, but it's less important now. And if his business deals in cash, credit provision for customers is not important. Now, this is the second 6-marker they can ask you. You have to be able to analyse how different interest rates affect the level of saving, borrowing, and investment. Higher interest rates mean there's a higher cost of borrowing and higher reward for saving. Therefore, people are more incentivized to save. The opportunity cost. As you can see in the graph below, the upward sloping supply curve represents the supply of savings, and the downward sloping demand curve represents the demand for borrowing or funds. When interest rates increase from R1 to R2, the quantity of borrowing falls from Q2 to Q1, and the quantity of savings rises. High rates of interest increase the cost of borrowing, meaning firms, consumers borrow less, and encourages people to save and not spend. And investment. Level of investment is inversely related to an interest rate. Because when interest rates rise, the cost of borrowing increases, making it more expensive for firms to take out loans to finance new projects. It also increases the reward for savings, so firms may prefer to hold on to money rather than spend it on risky investments. As a result, higher interest rates discourage investments, while lower interest rates encourage it. Thank you for watching Academic Scope. That is the end of GCSE OCR Microeconomics, and we're going to be moving on to Macroeconomics very soon. Thanks for watching, and sub, because we believe every student believes in A star.